Chapter 10 covers current liabilities and payroll. So liabilities that are current liabilities are ones that are due within a year. Remember that from our previous units. Our first goal is to describe and illustrate current liabilities related to accounts payable, current portion of long-term debt, and notes payable. Current liabilities are paid out of current assets, so from things like our cash, and are due within a short time, usually within 1 year. Accounts payable is an example of this. A current portion of long-term debt. So part of our long-term debt is going to be due within this year. So although it might be a 10-year loan, part of that is due this year. So we would call that piece of it current liability. And then notes payable. Accounts payable are what we get when we purchase goods or services for use within the company. When we buy something to resell it, like say we are a clothing store, we purchase a bunch of t-shirts to resell, that's accounts payable. Long-term liabilities are paid in periodic payments, and those periodic payments are called installments, a lot of times like monthly installments. So any of those installments that are due within this year are considered a current liability. The total debt or the rest of that long-term debt would be part of our long-term liabilities. The total amount of installments due after this coming year, like I said, are long-term liabilities. Short-term notes payable. We talked about these a little bit in calculated maturity values and maturity dates, and we talked about the knuckle method for the days and the months. Let's say a firm issues a 90-day 12% note for $1,000. It's dated on August 1st, and it's to Murray Company for a $1,000 overdue account. Previously, we talked about these as receivables. People were owing us, people were dishonoring the money they owed us. In this case, we made an oops. We're dishonoring a note that we owe them. So in this case, what we're doing is we're debiting our accounts payable because it's no longer an account payable for us. We have now made that a notes payable. So we credit notes payable because we've changed it from an account to a note. So this note we'll have to pay now, and we're penalized by having to pay a 12% interest rate on that. So this would be the reverse to what we've talked about with uncollectible accounts. We are the uncollectible account. So now it's a payable for us instead of a receivable. So on October 30th, when the note matures, we are going to pay the $1,000 principal plus the $30 interest. Previously, we've received this. Now we're paying it. So we debit our notes payable for the $1,000 because we've paid it off. Then we've got interest expense, which you'll see appears as an other expense. It's an expense to us because we have to pay out this interest. We owe the interest for changing our account payable to a note payable. We also have our cash credited for the total amount of $1,030. Here's another example. On May 1st, Bowden Company is the borrower. Purchased merchandise on account from Coker Company, who's the creditor. The amount was $10,000. Net 10, 2% at 10, net 30 are our terms. And that's because we have terms, we know it's on account, besides the fact it tells us on account. If it has terms, it's on account. And the merchandise cost Coker Company $7,500. So if you look at your notes, you have a space to be the entries for the borrower and the entries for the creditor. So you have to think of both sides of it. And we always often ask, well, what? Are we selling or are we buying? Well, for this one, we're doing both of them. Bowden is the borrower. Coker is the creditor. And they made a nice little play with letters here. Bowden, borrower. Coker, creditor. Makes it a little bit easier to realize that. Another word for creditor would be lender, in case you get confused. So we go ahead and take a look at this. Bowden Company, the borrower, we have an accounts payable. We bought merchandise on account. So our merchandise inventory increase, our accounts payable increase. Okay, so now we look at Coker Company. Coker Company made a sale. They are the creditor. They're lending us the money, kind of, by selling us the merchandise ahead of time, and we're paying for it later. So Coker Company, the creditor, they have accounts receivable, because Bowden Company is going to pay them. So it's a receivable for the person who is selling the goods. And we credit sales. We also have to account for our cost of merchandise sold and our merchandise inventory. If you're confused, go back, look at the previous slide, and look at the numbers to review what that is. Next, we have May 31st, where Bowden Company has issued a 60-day 12% note receivable for $10,000 to Coker on account. So basically Bowden can't pay their bill right away, so they're going to change it from an accounts payable to a notes payable. So that was what we looked at in our previous slide. Bowden, the borrower, says, oops, I can't pay my account on time, so I'm going to get rid of the accounts payable, and I'm going to credit notes payable to change it to a notes payable. For Coker Company, what is the account going to be? We did that in a previous chapter. Coker Company, somebody is dishonoring an account payable. So they have their accounts receivable changed to a notes receivable. This is review from the previous chapter. Now we're just tying them together, looking at both sides of the transaction. July 30th, Bowden Company actually paid Coker Company on the amount due on the note plus the interest. So it gave you the formula of interest: principal times rate times our time, 60 days over 360 days. Remember, in finance, we may use 360 days to simplify calculations. So Bowden Company debits their notes payable to get rid of the $10,000 note because they paid it. They have an interest expense of $200 because if you calculate this out, you get $200. And the total amount of cash they had to write their check for was $10,200. Coker Company, on the other side, is now receiving money. They're getting paid. So we debit cash for the total amount. For Coker Company, it's interest revenue. They're receiving the interest, and they credit the notes receivable to remove it because Bowden Company no longer owes them. On September 19th, Iceberg Company issues a $4,000 90-day 15% note to First National Bank. So we are issuing a note to the bank. So we have notes payable is credited because now we have this note going up. Now in the past we had been changing accounts payable to notes payable. In this case, we're basically borrowing money. So they're going to give us $4,000 in cash. We're going to sign a note saying we're going to pay the cash back later. On the due date, which is December 18th, calculated for us, Iceberg Company owes the $4,000 that they borrowed, plus the interest, again, principal, what we borrowed, times our rate, times our time, number of days over 360. So $500 interest expense, or sorry, a $150 interest expense. The total amount of cash we had to give back to the bank from borrowing it was $4,150. Discounting a note. A discounted note, this is a new term, has the following characteristics. The creditor or the lender requires an interest rate called a discount rate. So the lender is going to, instead of term it an interest rate, it's a discount rate, interchangeable. Interest, called the discount, is computed on the face amount of the note, or the amount borrowed, the principal. The borrower or debtor receives the face amount of the note less the discount, which is called the proceeds. So the borrower gets what the principal amount, but in this case it's minus the discount. So they're paying the interest up front. And then we actually call the amount that the borrower gets instead of the principal, it's called the proceeds, because it's the principal minus the interest, which in that case we call a discount rate. The debtor pays the face amount of the note on the due date then. So instead of adding interest in this case we did it backwards. Maybe when we look at an example, it'll clear that up. So on August 10th, Carey Company issues a $20,000 90-day note to Rock Company in exchange for inventory. Rock discounts the note at 15%. So to discount the note at the 15%, we take 15% off of the face value of the note. So $20,000 times 15%, we subtract that. So the amount of cash that's actually given is the $19,250. The $750, or the discount amount, is considered an interest expense. We're paying the interest up front. The notes payable is the $20,000. So we have to pay the face value back later. So instead of adding the interest on now or later, we paid it up front, and then we have to pay the principal at the due date, on the maturity date. So discount rate is that 15%, which we would normally call interest. In this case, it's called a discount rate. We have our discount of $20,000 times 15% times 90 over 360 to calculate the interest amount. The proceeds are the amount of cash we actually get, the amount we borrow minus the interest paid up front. On November 8th, the note is paid in full. So when we pay it, the note's payable, we pay the face value. And we are going to credit cash because we get rid of cash. The amount paid is the face amount on the note when you're talking about discounts. So discounts are done almost backwards of what you normally do with interest. Let's take a look at an example. In this example, we have July 1st, Bella Salon Company issuing a 60-day note with a face amount of $60,000 to Delilah Hair Product Company for merchandise inventory. A wants to determine the proceeds of the note, or how much cash would be received by Delilah Hair Product Company if it carries an interest rate of 6%. Letter B wants to know the proceeds of the note, assuming that the note is discounted at 6%. So an interest rate, interest is added on after and paid after. With the discounted note, you pay the interest up front. So the proceeds of a note with an interest rate of 6%, if we have that note and an interest rate of 6%, the interest rate is factored in at the end. So the amount of cash we receive, the money they actually give us, is the face value. We get $6,000, or sorry, $60,000. We get the face value because then we pay the interest later. With B, when we're determining the proceeds with the note is discounted, we pay the interest up front. So we need to figure out what the interest is, $60,000, the principal, times the rate of 6%, times 60 over 360, because it is a 60-day note. We calculate our interest rate to be $600. We subtract that out. Our proceeds are $59,400. So when it's discounted, again, you get less cash because you're paying the interest up front. That concludes your notes for tonight.